Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, 7:30 a.m. Mountain Time on September 29th. First, an apology. We had an issue with the audio in our first attempt, so we're re-recording and resubmitting this post to all of you. Um, Again, my mistake or my bad. So our note this week was titled "Run It Hot." Um, a lot of the themes in the note were a consequence of the 3 days we spent in New York City talking to money managers, hedge funds, uh, credit hedge funds, long short equity hedge funds, macro hedge funds. It was a really interesting day as always. We spend about 6 weeks a year out there in our old stomping ground and always enjoy the meetings and think it brings perspective to all of you paid and free subscribers. This week, I'm just doing one video for everyone. Please note for paid subscribers, there will be a payroll preview that I'll release on Tuesday afternoon, having seen the JOLT survey and Conference Board labor differential. And we'll put out a video or an audio on Wednesday morning, which will include some thoughts on ADP as a follow-up to that note on Tuesday afternoon. And then we'll be back on our regular schedule for publishing on early Saturday mornings. So there were 4 sections to this week's note. The first one was the 1718 analog. The second one was Run It Hot. Third was Radical Transparency at the Fed. And then we wrapped it up with our thoughts on the market and employment week. So our ideas around the 1718 analog, we started talking about, what's likely to happen next year and some of the themes going on in the fixed income market in particular. You all recall that the market managed a 20% rally in the first year of President Trump's first term, despite lots of policy uncertainty, getting bogged down in Obamacare repeal and replace, which delayed the passage of the Tax Cuts and Jobs Act. Ultimately, when that was passed at the very end of the year, there was a sharp rally in equities to discount the 10% level shift in corporate earnings. And that then peaked in January, and then the market crashed into Volmageddon, which was exacerbated by some volatility dynamics, but really was a consequence of QT and a shock higher in real rates in the belly of the curve, 5 and 10-year Treasury yields, TIPS yields, that is. Obviously, the conditions are different this go around, but the market has managed a pretty good move higher, and we think it'll extend into the end of the year. But then we still have this debt overhang. So we started talking about supply issues with respect to the fixed income market, potential increased supply from mortgages, potential increased supply from investment grade credit as the build out of the infrastructure moves from the cash flow from the hyperscalers to debt. We saw Oracle's $18 billion investment grade credit issue last week is a bit of an example of what could happen early next year, which could start to degrade this incredible technical that's led to tighter and tighter credit spreads, despite technical or fundamental conditions that, if anything, have kind of deteriorated marginally. So we're just starting to think about next year, and that's what that part of the note was all about. Run It Hot came out of a discussion with a macro hedge fund, and it was this idea that the administration is going to really want to run things hot next year. And does that create an inflation risk? And so we went through that dynamic. We got the revision to GDP last week, which looked like the economy was stronger in the second quarter, was stronger than had previously been reported. But the year-on-year rate didn't change, which meant they marked down some of the back quarters. And we didn't get the big markup in GDI that we got a year ago. We actually got a markdown of GDI, which was part of the reason why the bond market started to sell off last year. The whole outlook here really matters a lot. If we do get the capital spending recovery beyond just Gen AI that we expect, and to be fair, the capital spending plans surveys for September from the various regional Fed surveys, capital spending plans are going down, not up right now, despite the passage of the One Big Beautiful Bill Act. That would be a good mix of growth. Softer consumption, more capital investment. That's not inflationary. if we do get stronger consumption or a recovery in consumption because of the individual tax provisions from the One Big Beautiful Bill Act, or the administration were to get frustrated and worried about the midterm and start enact some more stimulus early next year using reconciliation, that would also be inflationary. So it could be a problem. So this whole dynamic of what the mix of growth is going to look like is going to be an ongoing point of discussion for us in the coming months. Moving on to the radical transparency at the Fed, we've been incredibly frustrated by Fed officials refusing to talk about the changes in policy beyond just describing tariffs. The first order effects of tariffs is potentially raising inflation. We didn't agree with that. The market doesn't agree with it. Governor Moran's speech at the Economics Club of New York a week ago today went through the impact of immigration on population growth, which should push the neutral rate lower, the impact of greater savings from tariff revenues, which should push the neutral rate lower, greater investment, which could push ultimately productivity higher and the real rate higher. So it was a really refreshing speech from our perspective. Whether you agree with the conclusions or not is of little consequence. We've been incredibly frustrated by Fed officials refusing to dig into these issues, with the possible or the exception of Governor Waller. And this was a really good speech in that sense. And so we covered it in the note. So looking out to this week, it's going to be all about the labor market. Last year, we got this shockingly strong employment report, plus 254,000 jobs. It was 100,000 greater than expected. The bulk of the report was weak. We think it was a data that was corrupted by their seasonal adjustment factor data that was corrupted due to the pandemic. The 16 to 24 year old category suddenly had this big surge in the employment ratio in the month they were supposed to be going back to school. We don't think it ever really happened. There was some strengthening in the labor market later on after the election. Small business confidence improved, but we think that that's unlikely to happen again this year. Earnings season is only a couple of weeks away, and right now it looks like the same theme is going to be true in that third quarter that's been true for the last year or so, which is communication tech and communication services earnings growth is quite tepid. We could have negative earnings growth in consumer-facing sectors, namely staples and consumer discretionary, despite revenues being up, meaning margins are coming under pressure because of tariffs. They don't have pricing power. They can't pass it through. Their margins are under pressure. And financials should start to improve, but the real jump we expect in return on equity will come probably early next year, assuming that we get the Fed rate cuts that we expect. So from a thematic perspective, we would continue to avoid consumer-facing sectors, staples, discretionary, and healthcare, lean into investment-sensitive sectors, industrials, materials, energy, tech, and comm services, though we've been reducing our exposure to tech and comm services. It's still a third of our recommendation, but it's below the benchmark of the S&P because valuations are getting stretched, and we're worried about but various drawdowns as a consequence of this having gone just too far. But we do think those themes will persist through the balance of the year, and next year could be a different story, as we described in the 17-18 analog. So you all get the same video this week. Next week, we'll go back to our regular approach, and for our paid subscribers, please look out for the payroll preview this week. And if you're a free subscriber, consider becoming a paid one. Barry Knapp from Ironsides. Have a good week, everyone. Sorry for the audio problem in our first attempt to record this. Thanks.